individual stocks, and I think that alongside index funds, stocks are the best way to manage your money if you have the time and the inclination, then you need to know what works. That's why I'm always searching for examples, for case studies that can illustrate how a beaten-down company can change its stripes, because some of the biggest wins I've ever had were turnaround stories. And right now, there's an incredible turn going on for some time in Snap. That's right, the parent of Snapchat. Not only was Snap the hottest comeback of 2019 with a stock that surged from 550 to 16 over the course of last year, nearly a triple, but the social media play just keeps roaring, climbing all the way to 19 as of today. The darn thing's now on the cusp of the 20s. I know I'm not early here, but I'm telling you, I'm describing the turnaround, and that would be the first time since 2018. I wouldn't be surprised if it does indeed have more room to run. Look, it's at 19.25 right now, and I think that it could go higher. Did I not do the piece here? Of course not. You can go to Twitter and yell at me. I don't care. I'm chill. What makes this move so remarkable? A little over a year ago, Snap had been written off and left for dead. I cannot emphasize this enough. After coming public to great fanfare in 2017, this eagerly anticipated deal quickly turned sour. As the growth peaked, the losses looked endless, and Snap's most popular format, Snapchat Stories, was quickly copied by Darth Vader Instagram. Even worse, Snapchat had been popular with young people and suddenly lost that cool factor. Remember when Kylie Jenner said she didn't open Snapchat anymore? That caused the stock to lose 6% of its value in a day. And those sellers were right, because it kept getting hammered. Hey, you don't have to keep up with the Kardashians, but it sure does pay to take Kylie Jenner seriously. As Snap's revenue growth slowed from the triple digits down to the mid-30s by the end of 2018, well, they still had no earnings. In fact, they didn't even have any free cash flow. So there was nothing for the more value-oriented investors to seize, to circle around the wagons when the growth guys lost interest. Very few buyers were willing to stick their necks out. Management seemed pretty clueless, which is extra bad. Remember that they're deeply entrenched because shareholders don't have any meaningful voting rights. And that's how the stock plunged from 29 at its 2017 peak down to less than $5 at its 2018 lows. Look at that. Ain't no valley low enough. Then last year, Snap got its groove back. At first, it was hard to understand why. By the middle of last summer, the stock was back up to the mid-teens. You had to wonder if this was just a relief rally, maybe a head fake. Turns out it was the real deal. Snap reported a fantastic quarter in July, made it crystal clear a turn was at hand. And then they did it again. And that's the most crucial piece of the puzzle here. For its first 2 years as a public company, no one trusted Snap because they kept missing the numbers. That's reasonable. But over time, they've become steadily more consistent to the point where they have earned the benefit of the doubt. And it now makes a habit of smashing the estimates. On top of that, management's made great strides on the profitability front. Now they're still losing money, but the losses have gotten a heck of a lot smaller. In fact, Snap may even turn a very small profit when they report their fourth quarter results the week after next. By 2021, the analyst community expects Snap to earn 28 cents a share, then rising to 56 cents a share in 2022 and 92 cents in 2023. I mean, this thing is no longer an earnings black hole. Best of all, Snap has ARG. That's accelerating revenue growth again. The company's growth rate bottomed out at 36% in the fourth quarter of 2018. See, stock markets anticipate this stuff. Over the course of last year, they gradually picked up speed. In the most recent quarter, Snap had a 50% growth rate. That is a major improvement. And you know Wall Street loves to pay up for accelerating revenue growth, and that's why we call it ARG. So how did they do it? How did Snap make those impressive numbers happen? How did this go like this? All right, first of all, they fixed their core product. Yeah, that's right. They fixed Snapchat on Android phones. Even when Snap came public and investors were excited about it, their Android app was garbage, which is not great, seeing as Android is the biggest smartphone platform. They tried to fix it in early 2018, but that redesign only made things worse. Last year, though, Snap finally figured out Android, and by last May, Snapchat had 41 million monthly downloads on Android, surpassing the previous record of 30 million from 2016. Meanwhile, they also fixed up their iPhone app, and the results was an across-the-board increase in engagement, which is what matters. Basically, Snap had a user experience problem, and they fixed it. Now, here's the crucial bit. The users started coming back, and so did the advertisers. When Snap came public, you know I was very worried that ad agencies might sour on Snapchat. That is exactly what happened as its user engagement deteriorated. But now that Snap's reaching millennials and smartphone-addicted Zoomers, advertisers are throwing money at the guys. Hey, by the way, throw in the fact that CEO Evan Spiegel started showing a level of focus that he seemed to lack when this one came public, and that's the turnaround in a nutshell. The question is, of course, can Snap maintain its momentum. Now, in the last few weeks, Snap has caught not one, not two, but three upgrades from major analysts and one analyst initiation at outperform. That's why the stock's surging nearly 20% just since the beginning of the year. That's a very big move, right? On January 8th, Jefferies went positive, citing the pickup in user growth and the improved ad platform. As they see it, Snap has a clear pathway to profitability, and the stock has more room to run in 2020. That's a quote. The very next day, Cowen upgraded too, based on the results of its annual ad buyer survey. According to their data, 10% of ad buyers say they'd use Snap to start a new branding campaign for 13 to 34-year-olds. Okay, so 10% may not sound too much to you, but that's 10% of the enormous global advertising market. And that's not going to impinge on Facebook. They are doing unbelievably well. But it's more than an asterisk. Plus, the 13 to 34 group is a coveted demographic. Advertisers want to get you while you're still young and persuadable. Then today, Baird published its social media survey, and this really got me noticed. It said things are looking up for Snap. And I quote, Snapchat surges among millennials. While Snapchat saw the smallest improvement in overall engagement trends, we noted the increase in engagement among the 25 to 34 age group was the largest single increase across all platforms and cohorts, supporting our view that users will remain engaged even as they grow older, end quote. That's that coveted demographic again. Now, I have some negatives. You have to be careful after such a monster run. I mean, there are real concerns here. For starters, Snap's seen 3 quarters of accelerating revenue growth, but eventually the law of large numbers is going to kick in. Numbers are going to start slowing again, making the stock less enticing. Meanwhile, Snap has some deep-pocketed competitors. Not only do they need to worry about Facebook, which I reiterate is the best in show, and Twitter, but now there's also this TikTok, and if you've never heard of it, go ask your kids. What it really comes down to is whether or not Snap can hit its earnings estimates. Company's expected to make 92 cents in 2023. This thing is trading at only 21 times the out-year earnings estimates. That makes it a steal even after this run. But again, only if they make the numbers. But I think they are. If the estimates are too low, this thing's headed to the stratosphere. It's the right stock for this environment. Bottom line, I do think the stock of Snap has more upside, and I am painfully aware that I'm late after this run. But I don't love that it's catching so many upgrades going into its next earnings report, February 4. So here's what I want you to do. I recommend, if you like Snap, putting on half your position for the quarter. Then if the stock gets hit after the quarter, you can go back up the truck. Oh, and Evan, listen to me. I know I was tough on you when the stock was getting hammered, but now I'm Jimmy Chill. And I welcome you on the show anytime to tell Cramer how you engineered this magnificent comeback. I want to go to Joe in New York, please. Joe!
Hey, Jim. How are you?
I'm a little thinner, thank you. What's up?
I wanted your opinion on Roku. All right, I went long this stock back in October around 119 and bought in some April options end of December, beginning of January to trade because this thing is so damn powerful.
Roku's so hard for me. It's so hard because, as I say endlessly, I didn't like it in the 40s, so who am I to like it up here? Although, thank heavens, I did kind of realize it was going up. Roku is a trade. When it's down 4 or 6, it always seems to work. When it's up, it doesn't seem to work. But you know what? Whoever thought it could get to where it is? Call it a snapback. The stock's got more upside. But consider putting on half of your position before the quarter, half if it gets hit after it reports. I wonder how I would look at one of those silly things. I got to try sometime. Now, there's much more Mad Money ahead, including my exclusive with First Horizon. How's the company positioning itself after earnings? I'm breaking them down. Then, is it too late to get on board the semiconductor train? I'm eyeing the space. And all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.